One day, the market feels exciting. The next day, it feels terrifying. If that sounds familiar, this idea is for you. The news makes every move sound urgent, but Benjamin Graham gives us a much calmer way to think. Inside the intelligent investor, one idea stands above the rest. That idea is Mr. Market. It sounds simple, almost childish at first, but it might be the most useful mental model in all of investing. Once you understand it, market swings start to look very different and a lot less scary. So who is Mr. Market? He is Graham's imaginary character for explaining how the market behaves. Imagine you own part of a business. Every day, someone knocks on your door. Some days, he is wildly optimistic and offers you a very high price. He acts like the future is perfect. Other days, he is gloomy and offers a very low price. Now he acts like everything is falling apart. That person is Mr. Market. He keeps showing up with new prices based on his mood. The brilliant part of Graham's idea is this. Mr. Market is your servant, not your guide. He is there to offer prices, not wisdom. You are not required to agree with him. If he offers a price you like, you can act. If not, you can ignore him and move on. And the next day, he may return with a completely different price. That is exactly the point. Once you see this pattern, the market becomes less intimidating. It starts to look emotional, not all-knowing. This is the heart of the lesson. The market is there to serve you, not to tell you what to think. When prices are high, Mr. Market can sound very convincing. He seems cheerful, confident, and certain. When prices are low, he sounds just as convincing in the opposite direction. Suddenly, everything feels hopeless. But the business itself may not have changed nearly as much as the mood. That's where smart thinking begins. Mood changes fast. Value usually changes slower. Think about your house for a second. If someone shouted a random price for it every day, would that control your emotions? Probably not. You would realize the shouting person is emotional, not necessarily accurate. That's how Graham wants you to think about stocks. Daily prices are not always intelligent. They are often just opinions, offered by a very moody crowd. So when you check a stock chart, the goal is not to panic. The goal is to think. Alerts, headlines, and market drama all try to pull you into reaction mode. That is where people get into trouble. The intelligent investor learns to pause. Just because the market is emotional does not mean you have to be. Instead of asking, what is everyone feeling? Ask, what is this business worth? That's why Graham separates price from value. They're related, but they are not the same thing. Price is what Mr. Market offers today. It may be fair, silly, high, or low. Value is your estimate of what the business is actually worth. That takes calm thinking. So investing becomes less about predicting moods and more about comparing price to value. You do not need to react to every quote. You need to judge whether the offer makes sense. That means studying the business itself. Earnings, debt, assets, and long-term strength matter more than drama. In other words, know what you own. The better you understand it, the less power Mr. Market has over you. That simple shift changes your role completely. You stop being a follower and start being a decision maker. Now here's where this gets practical. When Mr. Market is euphoric, you do not have to join the excitement. You can say, no thanks. A high price is not automatically a good deal. And when Mr. Market is depressed, you do not have to panic with him. A low mood can create opportunity. If the value is solid and the price is attractive, that is when his mood may actually help you. This connects directly to another key idea from Graham, the margin of safety. Even if your judgment is good, you can still be wrong. So you want room for error. That means buying carefully, with a buffer, instead of assuming everything will go perfectly. Patience, discipline, and safety may not sound exciting, but they are exactly what protect you. Most people lose because they keep reacting. They let the market's mood become their mood. Graham's message is simple and powerful. Let the market move around all it wants. You stay grounded. That emotional steadiness is a real advantage. It helps you make better decisions when others are rushing. So the goal is not to follow Mr. Market. The goal is to use him when he offers something useful. Every investor eventually faces this choice: react emotionally or think clearly. Mr. Market rewards the person who can stay calm, not the person who feels the most. That path may look slower, but it leads to better judgment. And better judgment is a huge edge. So if you remember one thing, remember this: price is just an offer. It is not an order. You do not have to obey it. And mood is not value. Excitement and fear are not the same as truth. That is why patience beats panic. Calm thinking beats emotional reacting. Put it all together, and Mr. Market becomes one of the most freeing ideas in investing. It reminds you that the market's emotions belong to the market. They do not have to belong to you. If you want more simple, clear breakdowns like this, subscribe and stay for the next lesson. And if you'd like to support the channel, you can also become a member or join on Patreon. I really appreciate it. Until next time, remember, use Mr. Market when he helps you and ignore him when he doesn't.